Welcome to Talk Tickers. Today, we are digging into Perella Weinberg's third quarter earnings call for 2025. And oh boy, the market had a lot to say about it. There's a ton to unpack, so let's just jump right in.
Okay, so the number that absolutely dominated the narrative for the day was this one, a 41% drop in revenue year over year. That is a huge decline, and it immediately set a really cautious tone for everything that followed.
So, first things first, let's look at the Q3 scorecard. And to be blunt, it was a pretty clear miss across the board.
And here's where we see just how much of a miss it was. Revenue clocked in at about $165 million, which was well below what Wall Street was expecting. And it was the same story for the bottom line. Adjusted EPS of 13 cents also fell short of the mark. Yeah, no matter which way you look at it, the numbers just weren't there this quarter.
And you know what? The market's verdict came in fast and clear. Investors pretty much voted with their feet on this one. The stock took a dive, closing down 4.4% on trading volume that was almost 2.5 times the daily average. The message from traders could not have been more obvious.
But, and this is a big but, while the market was zeroed in on the last 90 days, management was telling a very, very different story. Their focus isn't on today, it's on the long game and investing right through this down cycle. And this is really the core tension of the whole story. On one hand, you have that ugly 41% revenue drop, but on the other hand, you have the CEO, Andrew Bednar, saying on the call, and I'm quoting here, the number of active engagements is at a record, our overall pipeline is at a record. They're basically arguing that the activity they're seeing today will turn into the results of tomorrow.
And, they're not just talking, they're putting serious money behind that belief. Their strategy really boils down to three key things. First, they've been on a hiring spree, bringing in 25 senior bankers already this year. Second, they closed that really strategic acquisition of Devon Park Advisors. And third, they're using that deal to get much deeper into the alternative space, specifically something called GP-led secondaries.
So what in the world are GP-led secondaries? It's a super important and growing area in private equity. Basically, a private equity firm, the general partner, or GP, sells some of its best assets from an older fund to a brand new fund that it also creates. This gives the original investors, the LPs, a choice. They can either cash out their winnings now, or they can roll their investment into the new fund for even more potential growth. Buying Devon Park gives Perella Weinberg a serious foothold in this really active and profitable market.
And they can make all these big moves because their balance sheet is a fortress. Even with that revenue dip, they're sitting on nearly $186 million in cash, and get this, zero debt. That financial strength gives them the flexibility to invest in top talent and buy companies, all while the broader M&A market is kind of quiet.
This all brings us to the central problem for anyone trying to figure this stock out. When you're reading the tape, it feels like you're hearing two completely different stories at the exact same time.
And this slide just lays out that conflict perfectly. You've got the market's view on the left, which is totally obsessed with the bad news, the revenue drop, the EPS miss, the stock sell-off. But management wants you to look at the column on the right, the record pipeline, all the new senior hires, the future growth from the Devon Park deal. They're telling investors, hey, ignore the short-term noise, we're building our business for a big M&A rebound in 2026.
The hiding under the surface of all this was a really critical shift in where their revenue came from. While the big traditional M&A deals were weak, the firm's restructuring and liability management business actually picked up some of the slack. So that diversification helps soften the blow, and it's a huge part of their strategy moving forward.
So, this is the multi-million-dollar question, right? Who's got it right? Is it the market punishing the company for today's weak numbers, or is it management who's busy building a stronger, more resilient business for tomorrow?
And that brings us right to the next call, where we lay out our own thesis and rating for the stock.
Our rating is market perform. We totally see the strategic logic in their investments, but honestly, that sharp drop in revenue and the reliance on a future M&A rebound just keeps us on the sidelines for now. It's really become a show-me story.
So what are we going to be watching for next quarter to see if that story is actually playing out? Well, first, we need to see some real mandate wins and actual revenue coming from that new Devon Park team. Second, we need to see those 25 new senior bankers start turning their contacts into announced deals. Third, we're keeping an eye on that adjusted compensation ratio. It's at 67%, and we want to see if they can get that under control. And finally, of course, we need to see any sign of life in M&A announcements as we head into 2026.
All right, it's time for our plausible trade idea. For anyone who really buys into this diversification story, the trade could be a pair straight.
You go long Perella Weinberg, and you short one of their competitors who is just a pure play M&A firm. It's basically a bet that PWP's strategic moves will give them a defensive cushion and help them outperform if the M&A market just stays sluggish for a while longer.
And as we always say, remember, this is not financial advice.